It's a job.
That's right. Hey, everybody, this is episode number 13. After our detour, I've got Steve Newcomer. Did I pronounce it correctly?
Newcomer.
Newcomer, even better. Um, Here with me today, Steve is a mortgage broker. We've done a number of deals together, and our goal is in 15 minutes to break down for you, the listener, what to do if you need a loan and how you can do it the fastest and the best way possible to save you time and money. Steve, why don't you share a little bit about how long have you been? So it's Mill Mortgage is your
Correct.
company,
Yep.
and how long have you been in the financing business?
Yeah. So thank you, first of all, for letting me come on your show and for that warm introduction. So I've been in the lending business since 2001. That's when I got my start. So we're looking at maybe 24-ish years, something
So you
thereabouts.
started when you were what, 8 or 9 years old? Is that
21 years old. So right about the time I could drink, I jumped into the mortgage business also. Yeah. I just kind of fell into it. So I had some friends. Subprime was kind of big in those days, the thing that led to the financial crisis that followed. I had a number of friends involved in that segment of the business, and it just was attractive to me, the checks, but also, the process of it too. And I think as I got more and more involved in it, learned the nuts and bolts of a mortgage, finance, I've always had a knack for numbers. Mortgage, I think, is appealing to me. And in the years that followed, too, just became more and more. But figuring out that puzzle, that perfect fit for a client of what's going to benefit them, what's going to meet their goals, both short term and long term, and how to comfortably get them in a home. Number one, and then just more and more, just trying to give them the best experience possible through the process. So I think those would be my biggest motivators and kind of what drives me to continue down those paths. Better and better experience, more and more efficient of a process, all with the goal of getting that perfect fit to take all of their numbers, variables, goals, and just put them in the right situation as smoothly and as efficiently as possible.
so you fund loans in I believe 10 states?
That's correct, yeah.
And do you see different challenges in each market, or are the challenges very similar across the different states?
Yeah, good question. So I would say for the most part, a mortgage is a mortgage, and the nuts and bolts of that mortgage are going to be the same. And that's a lot of it has to do with just federal rules that are across the board with it. But then you get into state by state, and each state, puts their overlay, if you want to call it, of different rules or regs or disclosures or different little criteria that could make a difference. So for the most part, I would say a mortgage is a mortgage, but there can be little nuances state to state, mostly having to do with compliance issues and disclosure things.
Okay. I'm seeing the issue here with a lot of our homeowners that are locked in at this 3% interest rate, which we can assume that may not happen again in our lifetime, right? Where interest rate drops that low. Is that really affecting your business in terms of refinancing, or are a lot of these 3% homeowners pulling out cash equity lines of credit, and so you're still able to stay busy and able to provide a service for those people? What are you kind of seeing in that space?
Yeah, it's a really interesting environment. I would say that it's created different opportunities and different ways to serve a client's needs. Whenever I get into a conversation about the 3% and just people adjusting to that because it was the norm for so long, I would agree with your assessment that that may have been a once in a lifetime window of opportunity for those low rates. And if you think of everything that had to lead up to that even happening in the first place, I mean, that goes all the way back to the 2000s, and those faulty, mortgages that were being done, which led to the financial crisis, which led to a real estate crash, which led to a slew of changes that took place in the mortgage industry. Whole new set of rules and regs and compliance. Mortgage loan officers had to now be licensed, and a lot of things went into effect that then started rolling out in the years to follow, which then led to a recovery, which then led to a trend upwards in the housing market in general, and then all kind of culminating in a global pandemic, which then was kind of that final thing to drop rates below 3 in a lot of cases and into the 2s, which then led to inflation, which then led to higher rates. And it's kind of interesting when you look at that whole history. But to get to 3%, so much would have to happen, including a global pandemic, if you will, to get there. So yeah, I would agree. I think a normal range of rates these days, I think just based on what I'm hearing out there, is probably 5s. Maybe if we creep down to the 4s, that'd be pretty low. But I would agree with you again. I think 3s that was kind of a once in a lifetime thing. What I didn't realize, what I don't think a lot of people did during that period, because there was so much activity from those low rates, is what would then follow, or what would be the effect, from that. Because everybody was happy getting the low rates and the low payments, and that spurred a lot of activity. But then it kind of set it up to where now nobody wants to lose that low rate, and so you have an effect on sellers maybe not being as willing to sell, homeowners not being as willing to refinance to get the cash out if they wanted to. There was a period of time there from 2002 to probably 2003, maybe even a little into 24. There weren't a lot of refinances because it just didn't make sense. There definitely weren't any to lower the rate because most people had something in the 3s. Rates got all the way up to 7, even 8s in some cases. So there was no benefit to lowering a rate to save people money for a lot of years. Then you get into the cash out. Line of credits became popular because it was a way, line of credit, second mortgages, it was a way to still access the cash without disturbing the first mortgage that was already in place. So those became very popular. And then, as those years progressed, there was still, home purchase activity going on, just maybe not as much. And those led to people having mortgages in the 7 and the 8. So I would say in the past couple of years, as rates have crept more down into the high 5s, low 6 range, those refinance opportunities have come back for the people that had bought during the high rate periods. So yeah, it's changed quite a bit, and it's kind of interesting to look at the history and all that went into it, and then again the different opportunities and the different ways to meet your clients' needs as a result of it all.
Yeah, and the idea of what happened during that 2-3% period during COVID is we borrowed a lot of buyers from the future who weren't planning on buying a home, but all of a sudden found themselves in a situation where they could buy a home right now. And I mean, this was as I was just getting started. I'd have my license for 6 months, and then this happened, and all I knew was this moment, and people standing in line to get into open houses, and it was just a wild time to look back on it and really reflect, and it has just set us up for ultimately where we are today with inventory and interest rates, and area by area is performing differently. So you get to kind of watch these buyers experience the ups and downs of shopping for a home, which in a lot of people's opinion can be one of the top 5 kind of most emotional times in someone's life to make this big purchase. What are you seeing across the 10 states with your different clients in terms of what options they have and what kind of deals they're landing in different areas? Can you just give us a couple examples of what you're noticing? Because you have a very macro perspective, certainly in comparison to me, who is just focused on, let's call it 7 zip codes.
Yeah, I would say there Again, a mortgage is a mortgage, so I wouldn't say the product offering is too much different state to state, with the exception of maybe higher priced homes and just getting into jumbo mortgages, versus conforming. I do notice a difference in market activity, to your point. There are places like within Florida that are still very competitive. I have a client last week who'd been shopping for a while that finally was able to get something under contract. It kind of reminded me a little bit of those COVID years where you're dealing with multiple offers, and the home she eventually ended up getting, I believe, had like three offers on it. So there was very competitive. There was a lot of back and forth. A multiple counter was given. She ended up getting it under contract. But then you have other areas like I'm in Ohio, or Texas. Different parts of Texas are hotter than others. California. So there are different markets, I think, that have heated up and cooled down differently in comparison to each other. So I have noticed a little bit of that. As far as mortgage products, programs, they're pretty consistent state to state. As far as the type of client, I would say first time homebuyers, there's been a lot less of versus the COVID years, and I think that has a lot to do with the affordability. Investors, we've definitely done a lot more investor type loans than we had done in previous years. So that's another difference I've noticed also.
So let's talk to the listener who is that first time home buyer. Uh, Now they're going to either talk to a lender or they're going to talk to an agent first. They're going to talk to either one of us first. But from your perspective, what should they do first? And what does that process look like if you could draw up, hey, here's the perfect workflow for you as
Yeah,
a first time home buyer?
I would say talk to a lender first. That's usually a good first step, because it's important to know where you're at, what you can do, and where those numbers are going to end up at. Not only just to know for efficiency in going out and looking for what it is that you want, but also for the comfortability part too. Because I think, especially when it comes to first time home buyers, there's some nerves, could be some anxiety of just first time doing such a big purchase and not knowing how it's going to end up or where you're going to be. So going through that pre-approval process can filter a lot of that out and provide some comfort, especially in those areas. Just knowing, okay, here's what my credit score is based on my income. Here's what I can qualify for. Here's what the payment would look like, for that. And then I always like to have a separate conversation too, not only what the max is that you can qualify for and what that would look like, but also where do you want to be as far as comfortability wise, because it may be the max or it may be something less than the max. So I try to have a separate conversation in that regards too. Here's what that would look like based on where you want to be. And then that at least arms them with the information they need to where they go to you for the next step and start actually looking at homes. They're a little bit more targeted in what they're looking for. They understand the max and the comfortability and that balance of the in between. And they just kind of know a little bit more what they're looking for and what they can handle.
Yeah, and I agree with you 100%. The conversation should start with you as the lender. But the tug of war in that is that my compensation is tied to my relationship with that person. So you have a lot of agents out here in the marketplace that are saying, "Hey, consumer, come to me first, and I will introduce you to the lender because I want to create a sticky relationship with that client so that after they get their numbers, they come back to me and allow me to help them through the process." But it makes the conversation so much more powerful when they have an idea on what their purchase power is and what their willingness is to do that. Because then we can actually talk about their wants and their desires and why they want these things. And if the math doesn't math, it's not time for them to buy a home.
Hmm.
And I think something scary with financing is is how many of us go through our lives and we don't really know the truth of our financial situation, or we're like, I'm good, right? I got a car, I got a cool rental, I can go out in the weekends, right? I make $10,000 a month, or whatever that number is. I'm comfortable, but they don't really know where they sit from a purchasing perspective, right? Or what's next? Could they even afford a better rental? I want us to stay tight. I know we're going to be. I'm going to work to keep us under 15 minutes, but I want to run through one more scenario for
Sure.
our 17 listeners that are sitting on the edge of their seat right now. Um, Now, this prospective borrower owns a home, and they've owned a home, let's say, 10 years, and they've never refinanced, and they're sitting on this. Okay, they have their nice 3% mortgage, and it's time for them to get more space. And the option, and what we're seeing with the cash out refinance is that they're adding on, right? Oftentimes they're like, well, I can't afford to make the move, and I got to hang on to this 3%, so I'm just going to put a second story on this sucker, or build the, extend it. What does that conversation look like when those people come to you, and you just help my family in a situation, but I come to you and I have a $700,000 mortgage, and I'm at 3%, and I have a very comfortable payment, and I'm thinking I need more. I need more space. What's that conversation like for us? Hmm. That's the conversation there. I I just it's so interesting in what we do because there's this emotional component to moving, and there's a charge to it, right? And the numbers can mean one thing, and then actually doing it, right, and having the movers come. And in this scenario, right, in terms of doing a cash out, and let's say my choice is to remodel because I really just want to move across the street anyway. I just want the bigger house across the street. I want the kids to stay in the same school district. Um, okay, well, I can pull the cash out. I can go get in that rental. I can spend my quarter million uh, adding an additional, 600 square feet or whatever that ends up being. Ultimately, right, it comes down to clarity and making decisions that are right for your family, right, or you. Uh, Mhm. Absolutely. So I'm going to include Steve's contact information here in the description. Thank you so much for your time today. Episode number 13. We're going to keep them coming with all of your real estate professionals and the best way for you to move forward if you're thinking about moving. Thanks again for tuning in. Till next time. Thanks, Steve.